When you're picking stocks, size matters, but not in the way you might think. The size of a company can tell you a lot about what to expect from your investment. In this video, we're going to break down the real differences between small cap and large cap stocks, not just definitions, but some examples, past performance with historical data, the risks involved, and when one might be a better fit than the other. So smash that like button and let's get started. Welcome to Martic Finance, where we explain investing concepts in a simple way. But first of all, a quick disclaimer. This is not financial advice. Before diving into the debate between small cap and large cap stocks, it's important to understand what market capitalization means. Market capitalization, or market cap, refers to the total value of a company's outstanding shares of stock. It's calculated by multiplying the current stock price by the number of shares in circulation. This number gives investors a quick way to figure out the size of a company and where it fits in the broader market. Companies are typically categorized into small cap, mid cap, and large cap based on their market cap. These terms, like small cap and large cap, aren't just about how big a company is. They also give you clues about how a stock might grow, how risky it could be, and what to expect over time. In this video, we'll look at both types: small caps, which are usually younger and faster growing, and large caps, which are more stable and well known. We'll also give a quick explanation of mid-cap stocks, which fall in between. Understanding the difference between these categories can help you make better choices when investing. Small cap stocks are shares of companies that have a smaller total value in the stock market. This total value is called market capitalization, and for small caps, it usually means companies valued between about $300 million and $2 billion. Because small cap companies are smaller, they often have more room to grow quickly. Let's say it's way easier to double a $500 million company, and by consequence its stock price, than a $500 billion one. For example, a small tech startup that develops a popular app could see its stock price rise dramatically if the app becomes widely used. This growth potential makes small caps attractive to investors looking for bigger returns. However, they also come with higher risk. Smaller companies may face more challenges like limited resources, less stable earnings, or tougher competition. They might also be more affected by changes in the economy or industry, making them more volatile. Some well-known companies started as small caps before growing into large caps. For example, when Amazon first offered shares to the public on May 15, 1997, its total market value was about $560 million by the end of its first trading day. At that point, Amazon was still a small online bookstore taking its first real steps in the public market, so its stock clearly qualified as a small cap at that time. When Netflix went public on May 23, 2002, the company had around 600,000 subscribers and was mailing DVDs in red envelopes. Streaming was still several years away. Its market capitalization was roughly $300 million when it began trading on the NASDAQ. Who could have imagined that by 2025, it would be worth over $550 billion? Mid-cap stocks are shares of companies with a market capitalization typically between $2 billion and $10 billion. These companies are often more established than small caps, but not as large or dominant as the biggest players in the market. You can think of them as being in the middle stage of growth, past the startup phase but still with room to expand. That said, it's important to remember that market cap isn't the only factor that affects volatility. The most important driver is often the company's earnings performance, how consistently it generates profits or meets investor expectations. When a company misses earnings estimates or posts unpredictable results, its stock price can swing sharply. Other factors like debt levels, management quality, business model, sector trends, and even investor sentiment also play a role in how a stock behaves in the market. Large cap stocks are shares of companies with a market capitalization of $10 billion or more. These companies are often well known, with established business models and strong positions in their industries. Think Apple, Microsoft, or Coca-Cola. Because of their size, large caps often have more resources and broader operations, which can help them manage challenges and maintain more consistent earnings. That said, being large doesn't mean a company is stable or low risk. A big company can still face major disruptions, from regulatory changes to shifting consumer behavior or failed product launches. And sometimes, their size can make it harder to innovate quickly or adjust to change. For instance, Tesla, a leading electric vehicle manufacturer, has experienced notable fluctuations in its market capitalization. As of July 2025, Tesla's market capitalization is approximately around $1 trillion, about 100 times larger than the minimum required to be considered a large-cap stock. Despite its size, Tesla's stock has seen considerable volatility. For example, the company recently saw its stock price fall by 45% from its peak in less than 5 months. This was mainly due to disappointing results and rising political tensions. On the other hand, many large caps are attractive to investors because they often pay dividends and have a long-term record of delivering shareholder value. In conclusion, it's better to say they tend to be more mature and more closely followed by analysts. Like all stocks, they come with their own set of risks and rewards, and their role in a portfolio depends on your goals, time horizon, and risk tolerance. So, how to invest in small caps? Well, the great news is, you don't have to research or pick individual companies to get started. In fact, most investors today use ETFs or index funds. These are simple investment tools that give you access to a whole group of companies at once. They help reduce risk by spreading your money across many stocks instead of putting everything into just one or two. Since many of you are interested in investing in the US market, let's look at two of the most popular indexes. The S&P 500, which tracks the 500 largest US companies, like Apple and Microsoft. It represents the biggest and most established firms in the market. And the Russell 2000, which tracks 2,000 smaller US companies. These are typically younger or less established businesses with more room to grow, but also more risk. According to Curvo's historical data from 2005 until about the mid-2010s, both indexes performed fairly close to each other. But in recent years, the S&P 500 has pulled ahead, delivering stronger returns overall. If we look at the average annualized returns over the last 20 years, the Russell 2000 has delivered about 7.7% per year, while the S&P 500 has returned around 10.5% per year. This difference adds up significantly over time, leading to much stronger overall performance from the S&P 500 during this period. Of course, it's important to remember that past returns don't guarantee future results, and this isn't financial advice. Keep in mind that stocks carry much more risk than safer options like savings accounts. And finally, I want to thank you all. Our channel just hit 10,000 subscribers. I'm really grateful for this achievement and excited to keep improving the quality of my videos for you. If you haven't already, please consider subscribing and liking this video to help us keep growing. If you enjoyed this one, I think you'll like this video too. Thanks so much for watching, and I'll see you very soon. Bye.